toxic assets still as big a concern as they once were? I mean, it was certainly at the heart of the financial crisis. I don't get a sense for whether or not the government aid to a lot of these financial service companies has done anything to really address the assets sitting on the balance sheets of a lot of these companies. Aren't those toxic assets still there? And is that still a problem?
I'm glad you brought that up. So he's asking about toxic assets. Toxic assets that we're talking about, really underlying them are mortgage-backed securities and different derivatives of them and how they sliced and diced them. And well, that's all fine and dandy until house prices go down. And then nobody knows exactly how these things work. So then there's a complete lack of confidence. So then they can't sell them. So we're valuing these toxic assets at 10 cents on the dollar. Well, because they have to mark these to market, their balance sheet and capital ratios go down drastically. So how will we address that? Well, we pumped money into them as taxpayers through the government. And really what we need is housing to stabilize. Because, again, it's not the toxic assets. They're not toxic forever necessarily. If banks can hold them and housing comes back and starts to go up again, then the value of those assets starts to go up again and their capital ratios start to improve. And that's part of what we're seeing. And also what we're seeing is, I don't know if you've heard of CDSs, credit default swaps. That was a huge mess, kind of the toxic asset of toxic assets. But we're now seeing companies actually be able to sell those, which was impossible a few months ago. Nobody wanted to touch them. But now people are the market's starting to loosen up a little bit. So yeah, it's still a problem. Their assets are still out there. But if housing stabilizes here or in the near future, then the banks have the capital ratios that they need, and they can wait out the market, and as housing starts to improve, those toxic assets will become less toxic. If we get another down leg in housing, say mortgage rates spike because treasuries spike because foreigners stop, well then we're in trouble because those toxic assets are still there and they become more toxic. And then the question becomes, do we pump more money into these financial institutions or not? So really, the housing market, we've stabilized it for now. We think it will continue to stabilize and improve, but watching the housing market is still important. Yeah?
If what you're saying is correct, that the toxic assets, as we see, are what they are, and we're talking about the commercial side of that only starting to begin, what are we in for?
Well, the commercial side is a little different. One, because part of the problem with the residential side was it was heavily influenced by governmental action to encourage bad loans. And then there was a lot of financial engineering that went on at big banks as they sliced and diced these mortgage securities into different derivative securities that nobody really knew what the asset was underlying them. There's a lot less of that on the commercial side. So one difference is we see the commercial side coming. That's kind of the nice thing about the commercial lagging the residential, is we can prepare for it. We go, okay, we know that commercial's bound to go through problems as well because businesses are going out of business. You can see it coming. That helps. And unfortunately, it also helps that a great majority, about 80% of commercial loans are focused in regional banks. Well, they don't really have the either desire or tools to have these sophisticated derivative securities and slice and dice, and they just don't have that scale to be able to do that. So it's a lot simpler transaction, and that's where the trouble is going to be, is in these regional banks that hold these commercial loans. Well, I'm not saying I'd like this to happen, but for our economy, a few regional banks going out of business is manageable. We can, FDIC can cover that. We'll be okay through that. Citigroup or Bear Stearns collapsing, that's much more concerning. And they really don't have a lot of piece of this commercial mortgage market. So we think it'll be relatively concentrated in the regional banking area and not this kind of global, nationwide financial problems. So we think it'll be bumpy, but not nearly like it was. Yeah.
What's your current asset allocation?
What's our current asset allocation? As far as,
Assets.
well, that depends on where you are in your investment.
I'm asking you your asset, current asset allocation.
100% equities for me. Schwab doesn't have one for any broad. Each investor has a different stock, bond, cash, so we don't have necessarily a company-wide asset allocation. We have like sector calls that we're cyclically positive right now because we're positive on the economy at this point in time. So things like materials and technology, we think those are going to outperform at this point in time. But we don't have a broad asset allocation like that. Anything else? All right, well, yeah.
What's your view is when you think that we will actually see interest rates start to rise to combat inflation?
That's a lot of debate. When will interest rates start to rise? When will the Fed start to raise interest rates? Some people are saying into 2011. I think it will be sooner than that. I think we could see interest rates start to go up as soon as first quarter next year. I don't think we'll see anything the rest of this year. But there's two reasons behind that. I don't even think we need to see inflation concerns. But what these extremely low rates are doing is it's really killing money market funds. So any financial institution that has a money market fund, they're losing money on it. Because at 0%, those money market funds are really restricted on what they can invest in, usually T-bills. Well, with the T-bill earning basically nothing, to even pay the expenses and pay an investor 0.1%, that's losing money for people like Schwab and Fidelity and all these money market accounts. So I think the Fed's going to get some pressure to at least bump them up a little bit there. And there's this theory that, you know, the Fed, if it's seeing things improving, by raising interest rates, even by a quarter to say 25 to 50, that might help things move along, engender confidence in the public that the Fed feels comfortable with raising rates slowly. So I think it'll be a little sooner than a lot of experts think, but I think we could see early next year the Fed slowly start to raise interest rates. Not to necessarily slow down growth, but just to normalize things a little bit. These are still emergency measures. I mean, we're at 0 to 0.25% on the Fed funds rate. That's an emergency measure. It's difficult to see that we're still in an emergency. So I think gradually raising these rates and preparing the market for it will happen sooner than a lot of people